Cool. Okay, I forgot to do pleasantries last time, so I'll do them now. Thank you to the judges and organizers for helping make this tournament possible. Thanks. Penn is not here yet. I think Jason went to sleep or something like that. But thanks to the rest of Penn, they were there last round, which was really nice. Thanks to Clement, been a great partner. And I hate finance so much. Like my heart dropped when I saw this motion, but it's okay. Okay. Yeah, let's start. First on framing, who are you? One, you're already a top 15 bank, which means you're relatively large. This probably means you have gone through your fastest or riskiest growth period to get there in the first place. So to be clear, you're not in a situation where you're in massive levels of debt or like you're barely like even getting started up and you face massive pressure from creditors to rapidly grow because you already have like you've gotten to a point where you have a decent amount of money and not necessarily need to like be engaging in rapid growth through having smaller cash reserves, traditional accounting, and engaging in more debt. But second, you also have probably lots of investments that are making profit insofar as you are on the rise. This means your business is in good shape. You're not in a desperate situation that might call for riskier measures because, to be clear, the threat of like defaulting or like not being able to compete is probably not that prescient to you right now. You're doing good, which means that it doesn't seem like you need to be engaging in significant amounts of like extreme profit making capacities. Given that, three arguments. First, there is likely to be an economic shock soon, and you ought to be prepared for it through doing fortress accounting. Why? Four reasons. One, there are so many things that are fucked up in the world right now that are leading to economic crisis or shock. Things like tariffs, major war, environmental crisis, political upheaval, the demographic crisis, things like Trump just like engaging in like willy-nilly tariff and trade wars, all of which are things that are likely to mean that like yes, the economy is on a downfall and many companies are likely to be unable to pay back on debts that you give them. Many individuals are likely to struggle to give you back the money that you invest in. Which is to say now is not exactly the most like bullish market to invest in at all, which is to say that like the likelihood of crisis happening is extremely likely in the short term. And given this is an actor motion, the individuals who are controlling this bank are also CEOs, individuals who care about this short term. Maybe they might like you might say in the long term they'll survive, but these are individuals who are much more like aware of the upcoming risk. Second reason why there's likely to be an economic shock, though, is that there is a significant bubble that's existing for AI and PE firms, which is soon going to pop, which is to say that these firms are like rapidly increasing. People are putting ridiculous amounts of money into these firms, but like for not as much gain, that it's not actually clear how much profit they're going to be able to sustain, that many of these practices aren't sustainable and people are losing trust in the ability of them to continue making this money. But third reason why there's likely to be economic shock, governments also have far less fiscal room now and public debt has ballooned. After the COVID crisis, many of these governments like budgets have been out, like they've been far into like debt or default and haven't been able to like make much in order to afford helping individuals. So even if they might say, well, there are bailouts, many governments don't have the ability to bail you out, especially if you're a top 15 bank who presumably has a lot of money. This isn't just the US, but you could be a bank elsewhere. But secondly, there's also likely to be a lot of populist backlash against bailouts, which means that it's not certain that you're going to have that safety net in the case where you continue to like engage in like high levels of debt and don't have the safety net that fortress accounting gives you. Fourth reason why there's likely to be economic shock, though, is that a lot of these investments aren't likely to pay off, which means there's a massive risk of complete bankruptcy on your side of the house. Why do you much better protect against economic shocks? I don't want to note the wing here because they might say, well, you're not stupid. You're still going to reasonably. But the issue is that economic shocks are extremely difficult to predict. You might think it's not that often, but guys, 2008, like 2020, and probably now, these aren't that far apart. That's barely like the difference between a CEO coming into power and a CEO retiring. Those are things that happen more often than individuals are likely to believe and are also ones that are absolutely devastating. Like the difference is whether or not you fire like half your workers or completely restructure or sell off your assets because you go into default. This is the worst case scenario. Even if you believe the chance isn't that large, it's something that you ought to protect against the most. There are three reasons why we better protect. One, you have larger cash reserves to prevent default. You have more liquidity to be able to help individuals or like pay back creditors, etc. But second, when financial shocks happen, and this is critical, you can also get a lot of benefits because other banks are unlikely to all be doing fortress accounting as well, which is to say when other banks go into shock, you can make a lot of money off of, for example, mergers and acquisitions that you get with them or getting more of the resources that they have. Those are things that you're going to have a unique benefit while others aren't. Okay. Second argument then on higher investor confidence. I think there's a couple of things to note here, which is that one, a lot of people are expecting a crisis. They're expecting that economies are going to go down. They're not entirely sure that their money is going to be able to be made back, which is that individuals are looking for safe spaces to put money in the long term. But second, the flip of that is there's also less safe spaces to put money right now. Even US Treasury bonds, people don't think are that safe anymore because they don't know what the fuck Trump is doing. A lot of currencies are devaluing because of them being tied to the US or having a lot of trade with the US, which means a lot of individuals are trying to look for these safe spaces and finding less and less of them. This makes you unique because you're one of the very few banks that is going to have much more cash reserves, that isn't going to be engaging in as risky endeavors that you would have if you engaged in high debt, which means that individuals are likely to turn to you and you're likely to get a large number of creditors or customers. That increases the money that you have to invest in things, that increases your ability to make profit, etc. But finally, you're also likely to have a higher credit rating, which means you can borrow more at these times of opportunity. Okay, final argument then on why fortress accounting is just objectively beneficial to this bank, and this will exist regardless of whether you believe there's going to be an economic crisis soon, or regardless of whether or not the bank believes that they're going to weather the storm. 3 reasons why it is objectively better to be doing fortress accounting as this bank. First is that you often have the ability to differentiate on safety. Most of these banks don't do fortress accounting, and the fact that you are increases the incentive to people to borrow from you or to lend you money as opposed to others. Even in cases of non-economic crisis, many individuals who aren't as risky or don't want to be looking for massive levels of profit are likely to turn to you because you're one of the very few ones that isn't engaging in these kinds of actions. Secondly, it also means that you're likely to engage in higher scrutiny on who you're lending to. The fact that you have less, you go into less debt means you're giving less money to people. They're going to say that's a bad thing, but we say this is actually good. It means you have more scrutiny on who you're giving money to, that you don't you're probably put more pressure on workers to justify the investments that they're giving to you. And note, for extremely large banks, this is not something of oh well, obviously they're going to be careful anyway. A lot of these large banks often have the belief that they can survive it because they're so huge, maybe because they have a diversified portfolio, but any amount of these businesses failing is bad. That's money that you're losing, money that you're not putting in. And I think a higher scrutiny is likely to lead to your money being used more efficiently as well and getting you profit that's safer in that regard. But finally, traditional accounting is just never going to work on their side of the house for 3 reasons. One, that larger banks like JP Morgan are going to constantly beat you. They have access to collusion and resources, new AI models, the best analysts, institutional prestige and name, partnerships, etc., all of which are things that are likely to make them win in the battle of traditional accounting, where they also face less risk or can weather the storm better than you. These banks are also a lot more dominant. There's revolutionary new financial instruments that are making them gain more and more profit, and so fighting on their ground means you're almost never going to win. But outside of those banks, there's things like PE firms or equity funds that are also being set up to engage in highly risky behavior and giving people massive profits in return, all of which are ones that you have to fight if you take the side of opposition. For these reasons, oppose.
We thank that speaker and we invite the yellow.
All right, I'll do pleasantries now. Thank you so much to the tournament for hosting. I think that online tournaments are super important for accessibility, and I'm so happy that Drexel has continuously put this on. Thank you so much to the CAs for setting really interesting motions. I think this is a super interesting motion, as I have thought of lots of the other ones. Thanks to all the specs. Thank you so much to Alex and Clement, true friends on side op or on side gov, and I'm excited for the round. Lastly, thank you to Sherry. I think it's crazy. Sherry is a novice and has not debated for 2 years, and here we are in semis. She's definitely carrying me, not the other way around. And so I'm so excited not only for this tournament, but also to see how you grow in the rest of APDA. With that, framing off on. What does the banking industry look like right now? It's pretty much an oligopoly. Big banks have been in existence for decades and have built up their credibility. And we actually think that big banks are more likely to do fortress banking because, per all of the warrants given at the top of PMC, they, in fact, are the ones that have no risk, do not need to massively grow. In fact, they have built their portfolio where billion-dollar consumers turn to them for stability with all of their money. They don't need to incentivize higher returns. They are selling stability. They are selling the too big to fail mentality. JP Morgan, the CEO, Jamie Dimon, is literally the one who invented the term term fortress banking, which means that Gov just auto loses when at the bottom of the PMC, Alex literally tells you that fighting on their ground means you never win. Fighting on their ground is doing the Gov and doing fortress banking, which is why traditional accounting is the only way to actually make a name for yourself. The second framing argument is that this is not a choice between being safe or being reckless, because you still follow accounting rules to the extent required by law, and banking laws are incredibly relatively strict already following financial crises. What do banking regulations look like in this quote? For first, you have Basel III, which is an international standard, which says that you have to maintain a common equity ratio and buffers, which likely means that you always have to save 10 to 12% of risk-weighted assets. Second, these mandatory buffer levels are already in place to withstand times of crises. Banks also have to hold high quality liquid assets like cash or treasuries to survive a 30-day period. Regulators also enforce a leverage ratio cap, which limits total debt relative to equity, so banks can't over leverage, which is why 08 happened in the first place, because they were over leveraged, and because of FDIC insurance, in which it covers $250,000 per depositors. Retail depositors are already relatively protected and aren't necessarily super concerned about risk when they're choosing to invest in this bank. The third framing argument about what are the objectives of a rising bank, we think A, growth, B, optionality, i.e. you want to be seen as a counterpoint to banks that people are already traditionally investing in, and 3, you want to have market relevance. I also think the last framing argument is that who is likely to invest in you? We think that giant billion-dollar corporations who have money in all of their big banks are never going to take out their money from big banks and invest in you, because you have nothing to compete. And so it's not necessarily that you're fighting to try to move over these giant people, but you're likely fighting for the aggressive investors, for people who want something a little bit different, for people who have multiple nest eggs because they want to do different things with different parts of their money. So they aren't necessarily looking for another safe bank because they already have that. And notably, JP Morgan and Goldman Sachs already have massive reserves that you'll never be able to build up. So they're always going to be safer than you are, even if you are extremely super risk averse in how you invest money. So the only way to differentiate yourself and attract the specific type of aggressive investor who doesn't want safe money but wants to generate high returns. And so that is where they're looking for a new bank to invest in, and that's where you come in and become a market player on the scene. Now, some characterization. We think that this is also a critical inflection point in time because the bank possesses enough scale to compete with top-tier peers, but is not systematically dominant. This means that every allocation of capital either one, fuels expansion by loans, investment, and acquisitions, or locks it into defensive positions by holding reserve and risk buffers. A couple reasons why this is bad. And also note that given that the slope of ascendancy is so steep, so delayed or conservative choices compound opportunity costs because people get interest off their previous investments, and that always fuels. So the other banks are constantly getting more and more and more money while the value of your money continuously sits, especially because inflation means that the value of your dollar is always going less as it just sits in a bank account and is not making more money. Second, we think that market perception and investor expectations, where investors track performance relative to top 10 competitors, especially because you are required to put out quarterly earnings reports. So people are constantly looking to see as to where your investments are going and the returns that you're generating. We think that perception is super important. And so if you're a rising top 15 bank, you need to prove that you're aggressive and actually innovative in the type of financial products that you are marketing and your returns. You are never going to compete with JP Morgan, who are incumbents of scale, brand authority, regulatory infrastructure networks, liquidity advantage that will never be matched dollar by dollar by being more safe. You can only ever generate more money. And so the incentive analysis from who's going to put money into you are the people who want aggressive returns. We think that competitors can always outspend you by still being safe because they have more money. So they can spend 1% of their reserves, but still capture the fastest growing markets like digital banking, like fintech integrations, or investing into certain emerging economies. And so safety doesn't actually matter if you're irrelevant. Third, we think that the perception of risk aversion or over caution reduces capital inflows because you have a lower stock valuation, which signals stagnation. Less capital inflows because investors don't see you as safe, they see you as stupid, they see you as inefficient, because why do you have these resources but aren't actually using them? And so equity and debt investors will allocate their capital based on expected rate of risk adjusted return. If your bank is super conservative, you're not actually going to get money. Fourth, on talent, we think that talent and culture are highly sensitive to strategic signaling because aggressive growth attracts top tier risk, like taking talent, while fortress level caution just signals that you are rigid and unable to keep up. So the best talent in banking is opportunity hungry, alpha mindset, and growth driven. These top performers don't see any glory or challenge or opportunity for aggressive and creative moves. So while you're boring and don't get any money, all of the top talent is also not going to take a risk and join your bank because they just see you as small and useless. The second offensive argument is that the way in which you spend money is not just how you spend or what quantity of money that you're spending, but who you loan money to. On their side of the house, you're only likely to invest in super stable companies that have a proven track record, which is bad because investors often want exposure to asymmetrical upside. And so they want the early mover advantage because they want to get in something while it's small, but before it explodes into the next Facebook, they become a market leader. I think this is also important because of the rise of giant ETFs and retail investing, i.e. I can right now spend, put in $100 million million into an ETF that tracks the S&P 500. That's not actually why I want to specifically pay like banks to invest my money for me. I pay banks for this idea that they are going to get me the top 10, business innovation, so can I generate good returns, which means that we actually think that when on our side of the house, you essentially force this bank to necessarily be really, really strategic about what money it's going to put companies into. We're going to be able to generate higher returns, and you're also able to get more publicity, because now you're seen as this mover and shaker who is buying really interesting companies, who is buying PayPal before it explodes, or investing in these companies, which means that greater publicity on our side of the house when you get really interesting deals and those pan out well also encourage like more and more investors to invest money into your economy. And you're also able to talent unique VC or small businesses that you invest into, and then when they become huge, they have a level of loyalty to you, which means that they're going to continue to put money into your bank and not necessarily leave you. Let's go on to the on case. A couple of things that I think are really going to be important because they massively nice themselves. They tell you that, these investments aren't going to pay off and you're going to go into economic crisis. Notice that they have to be all of our reasons as to why you are going to be very safe regardless, because laws just mean that you have to be very, very safe regardless. And we also think that obviously you're not going to be stupid and you're not going to invest in stupid things. Now, Alex's preemptive response to this is that, well, shocks are hard to predict, but notably at the top of this argument, they themselves gave warrants as to why economic shock is likely, and then she gives you characterization as to why the actors know about these issues. So if you believe that an economic shock is likely and that the actors at this bank are individuals who are highly educated and have been able to grow this bank from shock, they likely know that an economic shock is likely to happen, which means that they're not going to be hella risky and invest and get into an economic crisis in the first place. They're going to specifically target what types of investments that they are making in order to make sure that they return. And notably, this strategy is for the long term, i.e., I don't have to advocate that they spend, all of their cash reserves right now on, Saturday 6th of 2025. I can just say that over the long term, they are more aggressive overall, which means that we can just wait around until the next recession happens and then go and be more aggressive. We probably get a little bit of modeling power as to how the bank chooses to do this. And I also think that they are just more likely to choose, specific sectors that aren't likely to be collapse immediately in terms of crisis, and there certainly are safe sectors. Also, I just do think that '08 was predictable. Did you see The Big Short? People did know that it was going to happen. Then on the argument about better protecting and how other banks don't do fortress accounting, I think that even if you are doing fortress accounting, you're not big enough to be considered safe, which means that during periods of economic crisis, people are always going to pull out the money from your bank and put it into the giant ones that are considered too big to fail. So in terms of economic crisis, you're likely screwed already because you're not big enough, which means the only way that you can differentiate yourself and the only way in which this round matters is times of not economic crisis.
We thank that speaker. We invite the MG.
All right, everybody. Some pleasantries, I guess. Haven't debated all summer. Glad to be finally back. I'm glad that Drexel is hosting this tournament, so we're able to de-rust relatively early. Thank you so much for Alex for partnering with me. We've always been talking about going to tournaments together, and this is our first tournament actually together, which is very, very fun. Thank you to everybody who's been running the tournament. It's been pretty interesting. I like the motions. I like the Austral set that we had earlier. So yeah, good luck, everybody. Structure-wise, it's going to be on a few clarifications and then on case, off case. All right. The biggest issue of opposition is they can't decide on really what they want these banks to have, right? Because if it's true that all the big traditional banks like JP Morgan just do fortress banking and they're always going to succeed, and there's also going to be future innovative banks that come along and take over you, the problem is that on their side of the house, you're all just having a doom and gloom situation that by the next economic crisis, and you're unable to compete at JP Morgan, you'll never become the greatest bank in the world with the largest bank. You'll always be stuck in the same middling sector, only to be overtaken eventually by somebody who is more innovative with you. Our side of the house prioritizes the fact that you're playing for the long game, that you're not trying to be the biggest bank in the next 10 or 20 years. You're trying to slowly grow in the same way JP Morgan, all these other large institutions did, into the status that they have currently over the next 50 or 60 years. Several pieces of argument here. Firstly, that why does Trace tell you that these big banks all collude and they all do fortress accounting currently. Therefore, you cannot compete against their fortress accounting, and that's why you need to prioritize something different. Several responses here. Firstly, big banks do compete in very, very risky behavior insofar as they compete each other massively, especially since these large banks to deal with new upstart banks are coming up, right? JP Morgan's biggest competitor isn't other American banks. It is the fact that Chinese banks now collectively have almost as large of a banking like stock profile as them. They have massive amounts of competition, which is why they do take risk against each other. But secondly, new financial technologies are fundamentally changing the financial landscape. It used to be true that previous upstart banks like yourself couldn't even break into the 15 within the 10 years or 20 years, but now smaller banks are able to do so with things like new financial technologies like AI modeling, which is why JP Morgan is spending huge amounts of money, like $50 billion on their latest artificial intelligence market models. That's inherently very risky because it's new technology that might pay off, but it shows the amount of desperation that they're doing. Very few of these banks are going on the traditional fortress bank that they've constantly doing previously. But secondly, it isn't true that these banking regulations that they say in the status quo are just so good that there's never going to ever be an economic crisis ever again, right? Firstly, these banking laws are incredibly strict. Not only do they only exist barely in the United States, importantly, the incoming economic crisis is likely to be a lot larger than 2008, right? Things like a war between China and the United States will cause about like a 10% shock to the world GDP within a week. All of these things are going to be something that the previous bank regulations couldn't have handled, which is why this is massively important. But secondly, they still have to choose a side in this debate, right? If it's true that traditional banking is already just incredibly safe, there's practically no difference between that and fortress banking, and there's no trade-off in this debate. Thirdly, they say banks that know an economic shock is likely to occur because Alex knows that economic shocks are likely to occur, so they're going to be safe. This has never worked in the entirety of history because our point isn't that people don't expect the economic shock, is that they don't know what exactly that shock is going to be, and they don't know when exactly it's going to come, so you don't know if you should pull back now or you should pull back later. Our argument is that it's better to pull out now, so not only do you avoid the consequences of a war starting tomorrow or the economic shock coming tomorrow and not being prepared, but more importantly, these are things that are fundamentally unpredictable and that very few people predicted 2008. It was a reason why banks that were traditionally massive, like the Bank of America, like Citibank, are no longer the largest banks in the world because they failed at this, and JP Morgan and the current large banks can fail as well. Lastly, they tell you that you're fighting for very aggressive investors, right? Not traditional investors, and therefore you need to differentiate yourself from the other banks. The problem with this is that on their side, they're prioritizing differentiate themselves from the largest bank that exists, but they don't explain why you necessarily differentiate yourself against all the other smaller banks smaller than you, or all these startup firms that are a lot more innovative, a lot more mobile. The problem with this is you cannot constantly be on the cutting edge of innovation for a few reasons. One, other innovations will continue to happen that you're going to miss at some point or another because they just don't happen in the area that you want. They don't happen within your offices because it's somebody else that came up with these ideas. But secondly, as you grow larger as a bank, it becomes harder because you're bogged down all the bureaucracy, right? This is why smaller firms are easier to maneuver than larger firms. So these fundamental reasons means that you're never going to be the most innovative bank, and if that's the only thing you prioritize, you're not going to have the same level of success as these smaller banks, and therefore you wouldn't be able to get these investors as well. What then is the comparative, and why is it it's possible to pursue traditional fortress banking over other sorts of banking? The benefit of fortress banking is that it's inherently very risk adverse. That is to say, even if you take like a 1% loss a year due to inflation, you're still able to survive for 10 years and still stay relatively stable, because even if you're not as safe as JP Morgan, as profitable, because they have this reputation of being incredibly safe, you're still able to survive. And when the other smaller banks that are next to you, the 14th, the 13th, the 12th, or the 10th next largest banks fail during the economic crisis, that is when you have the ability to build up the capital that is necessary to overtake JP Morgan in the long run, because right now you don't have the capability to do so. You can never compete on their level until you have the ability to build up this gradually, and attempting to do it really quickly harms us in the long run. But furthermore, why is it that financial accounting matters, particularly for a younger bank that's on the rise like the motion states? Because the banking industry is incredibly hard to break into, right? So as they characterize, logically only broke into this industry by being incredibly risky and innovative. This is harmful because the banking industry in the long run relies heavily on prestige and reputation, right? Is that people perceive JP Morgan to be a place that has a great reputation for financial safety. That's to say that when all these other traditional banks have far better better reputations than you cannot continue to be seen as this risky upstart nation. You need to have that reputation build up over time. Reputations don't build up quickly. They build up over decades of a continuous policy and a company culture around fortress banking that even though right now it means slower growth, it means you may drop down in the rankings, in the long run, it means that more people are more likely to put money into you. They're more likely to give you the amounts of money and view you as the same stable institution that has been around forever in the same way JP Morgan has been in the long run. Why is it then that weighing on long-term growth matters far more in this debate? There are a few reasons why. One, the global economy, minus the occasional massive depression, generally trends up, which means that unlike what they said that you'll be beaten by inflation, as long as you continue to go gradually, you're still likely to hold the relative amount of money that you have as long as you're not taking horrendous risks happening in the future. But secondly, individual analysts within your own bank and your own bankers and your own CEOs tend to be biased towards the short term. That there are psychological aspects to being human, right? You have a fear of missing out. You have financial FOMO. There's the idea that nothing ever happens or Trump always chickens out. That your own traders can be influenced by fear or other emotions or whatever the current economic zeitgeist is. So employees have this private incentive to also make profits, right? Because they want to make money in the near term within the next few years or be promoted and get bonuses and advance their careers. So all these are external reasons why your own employees are going to be tainted by their own visions of what is the correct thing to do by a bias towards the short term, which is why you need to counter out that bias by the tendency to be more risky by pursuing a policy of fortress behavior, which is more likely to reflect actual market conditions than whatever your own psychologists say and your own analysts say in the long run. Lastly then, why are you unable to win the competition in traditional accounting? The reason why you're unable to win the competition in traditional accounting is for two reasons. One, the smaller banks are more flexible and maneuverable than you, have a greater ability to maneuver around and have an absolute advantage over you. But the second reason is that the largest banks, for the same reason Ali says, who have all the resources to just throw massive amounts of money and new financial technologies like AI, will also be able to compete against each other. So the future of banking is going to be the largest banks trying to constantly defend their position against the upstart banks that are trying to take their positions there. If you don't have the ability to enter into that fight in the first place, it is better to wait that fight out rather than engage in that fight and actively lose money in the traditional accounting because you're going to be less profitable and they're going to beat you at these trades, or comparatively, you have the ability to profit off wherever they fail because you have the cash reserves that you haven't loaned out to anybody, therefore it doesn't rely on investors and it belongs to you to use that to capitalize on the fact that certain banks fail. You get to buy them up, you get to take up your market space, you get to drastically use these resources in most instances. So for these reasons, on our side house, you're more likely over in the long run to fare a better job or at least survive, and we think survival is the fundamental basis for your bank. Very proud to propose.
We thank that speaker and we invite the MO.
Some brief notes before my speech. I want to say a huge thanks to Ceci, my partner. I'm so lucky to have you as an introduction to APDA debate and making it so much fun. And thank you to the CAs for hosting such a great tournament and to my competitors for the awesome rounds. This tournament has been a really fun and exciting return to debate. Side government concedes the obvious. Our top 15 bank cannot hope to compete with the tsunami of resources, infrastructure, and entrenched brand authority that defines a Goldman Sachs or JP Morgan. We accept their premise. They also claim that by virtue of already being top 15, the bank occupies a reasonably secure position, insulated from immediate failure. Taken together, these facts that make up the majority of their warranting reveals a profound strategic insight that insofar as the bank has already met the critical threshold of survival, yet faces an enormous gap to the top, in that space between security and supremacy, there exists functionally nothing to lose. Because I think that their argument here assumes that the bank must adopt fortress accounting in order to do things like survive shocks, yet simultaneously claims that the bank's structural position, always middling, never top tier, is inevitable. I think that this is a category error insofar as their prescription conflates risk mitigation with competitive strategy. I think that risk avoidance does not produce survival in a vacuum, produces stagnation insofar as a top 15 bank is not a static object. It is a dynamic actor in a competitive ecosystem of capital, talent, and innovation that is functionally zero-sum. By fortressing, the bank forecloses any differentiation. It cannot seize opportunities. It cannot attract strategic investors seeking growth, and it cannot leverage crises to outmaneuver rivals in the first place. Their logic assumes that survival is binary, but we think that they actively fail to account for relative advantage, signaling effects, and market positions. But I just want to turn the impact here on imminent crisis, because I think that this is often functionally a lever for ascension instead of retreat. If a crisis hit, banks that are risk averse will miss the most critical opportunities to capture distressed assets, market share, and capital inflows. Meanwhile, a bank that maintains strategic agility can selectively deploy capital to secure outsized returns, attract the most ambitious talent, and establish reputational advantage, turning systemic shocks into a functional force multiplier. This means that we win even in the worst case framing on our side of the house. By forcing fortress accounting, they guarantee the bank cannot respond opportunistically, effectively turning their own protection argument into a recipe for irrelevance. However, I just want to briefly refute the claim that you need reputation over time, and this only builds after being conservative for a number of time. Because reputation in banking does not arise from hoarding liquidity. It arises from performance under real risk, reliability in execution, and the ability to seize opportunities, all things that exclusively happen on our side of the house. Because insofar as it's not just playing it safe, it's artificially constraining the bank, slowing down deal making, reducing market visibility, and signaling active timidness towards both new talent and investors in the first place, which smaller opportunistic banks can exploit to capture high profile deals. Because I want to note here that given that the economy is not zero sum, the bank did not ascend to the top 15 by conservatism. Every step, such as capital allocation, investment in volatile markets, aggressive M&A, risk-laden lending, was calibrated for maximum market penetration and signaling. That's how it got to its status in the first place. This means that top-tier status is a cumulative effect of repeated risk-taking, not passive balance sheet management. Note that here, investment psychology is ultimately path-dependent, because given that investors evaluate banks relative to their trajectory, not just some abstract notion of safety, the bank's reputation was built on this functional form of observed courage, deal execution, and market aggression. This means that competitive positioning is emergent here, because every single time you signal that your trajectory has fundamentally shifted, that you are no longer courageous nor aggressive, nor having this differentiation space that is unavailable to smaller banks or peers, these same investors who invested in you for those qualities are going to shift to smaller banks that become your competitors because they exhibit the very same qualities that you used to have that attracted them to you in the first place. Know that given that you losing is them winning and vice versa, this structural advantage is fragile. It cannot be preserved by switching to fortress accounting without eroding the very and most important mechanism that produced your status and your stability in the first place. Okay, next I just want to note that their crisis framing is functionally self-defeating, because when you claim that a crisis is imminent and thus we must hunker down and protect ourselves, I think that a crisis does not equally threaten all players. I think I talked about this a little at the top, because risk exposure is not uniform here. Smaller banks, competitors with high leverage, and inefficient institutions are the first casualties insofar as the top 15 bank has surplus capital, low debt, and the operational scale to survive it. Fortress logic assumes that all institutions are equally vulnerable, but this is categorically false when we actually approach the situation with nuance, because the very attributes that make you top 15 allow you to asymmetrically profit from instability. Okay, however, I want to talk about our worst case scenario in which crisis hits the top 15 bank and losses occur due to market volatility or counterparty fault or bad loans or asset devaluation. Even assuming maximum reasonable damage, the bank survives but returns are lower than hoped. We still win in this scenario because fortress accounting fails under stress anyways, insofar as your cash reserves and low leverage do not immunize you against things like the opportunity cost of being passive. You cannot acquire cheap distressed assets. There exists massive client flight when high net worth clients and corporate depositors seek active opportunistic banks, even if risk is moderate. And this means that you have market share erosion when competitors who move decisively capture the spoils of your losses. We can functionally turn this argument, because even if your fortress logic protects your capital, it guarantees missed upside and opportunity costs, which in active comparative advantage for the aggressive banks means that everyone will flight towards your competitors. Okay. However, I just want to make one thing clear. What is our cleanest link into growing this bank towards being able to compete with people like JP Morgan and Goldman Sachs or the gold standard of banking or whatever? Okay, because insofar as you have asymmetric opportunity during crisis, others' vulnerabilities become our upside lever even in the most dangerous and imminently crisis situations. For example, in 2008, top banks with capital bought distressed assets at fractions of the value, compounding returns returns years later. This means that crisis magnifies the benefit of risk taking. So even if we incur temporary losses, the strategic positioning payoff exceeds them. But also, just on the note of signaling and social capital, because I think that market perception is really key here, and we flagged this in LOC. Because insofar as risk taking marks itself as like reputation as adaptive, dominant, attracting deposits and partnerships and investors, even during a downturn, Fortress strategy means that you have reputation as a cautious, inert, and like driver away of capital. Because even if the crisis impacts us temporarily, our credibility and strategic position improve relative to the cautiousness of it all, generating a durable comparative win. Okay, compounding our worst case impact turn. They claim that a crisis will hit, so we must hunker down. We grant them that this crisis occurs, and yes, losses hit, but these losses are fundamentally smaller than the losses of inaction, proving to you why we win even in our worst case scenario. Okay, next. They functionally say things like US bonds aren't safe, currencies devaluing, and fortress accounting makes us uniquely attractive. Okay, I think that safety alone is not leverage, because perception versus utility has a very large gap here, insofar as customers may perceive fortress banks as safe, but the safe product is inherently low yield, insofar as high net worth clients seek returns here. Because like in terms of just like the competition for attention, even if a few banks adopt fortress, other instruments emerge, things like gold or crypto or fintech platforms, international portfolios. Fortress accounting cannot monopolize safety perception, but also just in terms of the operational rigidity that happens here. Okay, I think that fortress banking creates bureaucratic inertia insofar as workers must justify every move. Approval chains are so slow, and client responsiveness suffers in a volatile environment where speed equals survival, so scrutiny backfires. Okay, I just want to be very intuitive here. When you are talking about the things that drive growth, things like attracting top talent, things in attracting more clients and like more investors, they're not what differentiates you from JP Morgan or Goldman Sachs is not like the quality of your fundamentals insofar as you can never compete with them, but the amount of asymmetric upside that you were able to expose them to. We think that this happens exclusively on our side of the house. Very proud to oppose.
We think that speaker, and we invite the LO.
Okay. It'll just be an LOR. The first piece of framing I want to talk about is, do banks fail? Both your bank and other banks. They've conceded that there are a variety of regulations that exist regardless of what type of accounting you do, because they're just set by the government, and traditional accounting still has to follow these laws. So you have to save about 12% of your risk-weighted assets anyway. You have to hold high volumes of like liquid assets and high quality liquid assets like cash, enough to survive like 30 days. And you also have a leverage ratio cap, which limits the total debt relative to equity, so you cannot over leverage, which is what happened in 08 in the first place. What does this mean? It means that even during times of economic crisis, you are probably not going to fail, even if you do traditional accounting. And most importantly, the other big banks aren't going to fail, even if they do traditional accounting. Secondly, they've also conceded that big banks do fortress accounting. They say this themselves in MG, but they also don't respond to the warrants about which we tell you that big banks don't need to generate high returns to get money, because they rely on prestige that they've built up over decades, this too big to fail mentality, and they themselves quite literally invented the term. This is historically what they have done. Which means that big banks never actually fail. So you cannot profit during times of economic crisis when they actually go down. And even the smaller banks probably also aren't going to fail during times of economic crisis, and so you can't necessarily buy them out. I would also say that during times of economic crisis, they have also conceded that even if you are a fortress, it's not actually enough, because during times of economic crisis, people pull out and only invest in super safe things. So they're always going to pull out from you and putting it into the super big banks like JP Morgan and Goldman Sachs, because they are seen as too big to fail, because they have just like exponentially bigger returns than you do. So regardless of what you do in the short term, it takes decades to get the prestige to maintain money during periods of economic crisis. And if you believe Alex's warrants that economic crisis is likely to happen in the short term, it means that no matter what you do now, you're not actually going to be able to save your money. And what was the weighing at the bottom of LOC? LOC tells you that the what we should argue me about in the round is not about economic crises, because you're not going to be able to like get up to the point where you're able to like be stalwart and not like lose your money, and you're probably also not going to fail. But periods of regular economic growth are also more important because it's what you have a capacity to change more often. And I also think that we should prioritize periods of regular economic growth because they also tend to happen longer, i.e. we typically get, 10 years of good growth and then 1 year of recession. That's the traditional business cycle. So we should just prioritize what arguments are going to impact your bank during the vast majority of the time in which you are happening. With that being said, what are our ballots? First, a little bit of characterization that they miss of who actually invests. We tell you that aggressive investors are the people who got to you in the first place, and they are the people who are likely to put certain amounts of money into a new bank. Because if they wanted their money to be super, super safe, they would never go to you, right? They would invest in treasuries, they would hold cash, they would put them in big banks, they would just invest, be a retail investor, and put them in ETFs tracking the S&P 500. All of these are safer places for their money. The reason why investors pay banks to invest for them, and specifically you as a slightly smaller bank, is because they want to generate aggressive returns. And you get these investors when you have quarterly returns that show high returns and profits to investors, when certain investors talk about how amazing their returns are because of you. And also they've missed the warrant that you get these really cool deals when you get high levels of publicity by finding the next Uber or PayPal. So you also attract investors in that way by willing to take a chance on smaller companies. When you do traditional accounting, in addition to having less money and so not being able to have as higher returns, you also are much more risk averse in what types of companies you put into. So you're more likely to invest in only like really stable companies, which means that their potential of, massively increasing revenue and thus massively increasing profit to you probably isn't actually very likely. Secondly, so you probably get more investment that way, and we think that that's probably what you care about because you want to grow as a bank in both prestige and both capital, etc. Secondly, when you help these smaller companies grow, they stick with you for trusting them. So they don't even care that JP Morgan is technically bigger because JP Morgan wasn't loyal to them in the first place. This is important because A, it operates in the long term, but it also operates because even during periods of economic crises, these giant companies.
That's new. The material on how like the firms that you worked with long ago in the past are going to stick with you in the long run, even if other firms like JP Morgan make for money is new and reply.
I think that this is like the bottom of the LO is that like you invest in the smaller companies and they stay with you.
Yeah, we'll take it under consideration. I have you at 406 elapsed.
This is just true on a warrant level because they have conceded that JP Morgan doesn't need to make that they don't need to make good investments. Like, you don't need to take risky investments, so they're not likely to invest in the startup companies. And then on the weighing, we also think that this is important because even in their best case, in which there's a term of economic crises, the next Uber and the next PayPal is always going to stay with you, which means that even if all of your other assets fail, you found the next Uber and you're going to be profitable in the long term. Very proud to oppose.
We thank the LO and we invite the PM.
Can I be heard and seen, I guess?
Yep.
It's just gonna be 2 ballots. The first ballot is the current context means fortress accounting is preferable. This motion is literally, as a top 15 bank, would you do fortress accounting? Like in the SQO in top 15 bank, are you going to make this choice or not? They say this is about long term. I'm gonna note a couple of issues here. First, I think our analysis in PMC actually beats this by explaining the likelihood of these crises going up, that the probability of these crises increasing. Environmental crisis or political upheaval aren't things that are temporary, but ones that are consistently happening. The world is getting worse, and these are unique circumstances that are changing. But critically, there are political crises that haven't happened before, like massive backlash against bailouts is fairly recent. Yeah, sorry.
Sorry if I missed this, but I think it said in LO that like, oh, we don't have to invest everything right now, that this is a long-term strategy. And so the response about like, oh no, it has to be right now because of the like motion is new.
I mean, I think that like I'll just do the argument from PMC if that works. Like this is just like PMC like analysis that you're this actor making this decision.
All right, we'll take it under consideration.
Sure.
I have you at 36 seconds elapsed.
Okay. Yeah. So again, this is about like you as this actor making this decision. We explain to you why you're likely to believe this is not going to be like the right thing to do, why you're likely to believe it's not a bullish market, that many of these individuals aren't interested in looking for the most creative or innovative things right now, but rather are looking for safe like context because of what is happening in the SQO. Like this is all like PMC argumentation. I just don't think it's new. And no, it's not like they say you're going to be reasonable anyway. But it's not about being reasonable. It's about showing you're extra safe, showing that you can weather the crises that are happening now and the worsening economic situation that is happening now. They say you wait it out. Like, again, like I think we explained why this is unlikely to be like something that you're thinking, like this is unlikely to be the most proximate thing. And they also miss the analysis from PMC, which explains why like the fear of these current crises is the most proximate like impact on your decision making. Because you are a CEO who's probably going to like be retiring or leaving that position within the next 5-10 years. You want to wait it out, but those profits aren't going to wait it out for you in the next 20 because you're going to be fucking gone. So you do care about those current, like ensuring that the company survives in the short term, even if you are just like the like leadership of this company right now. I think this weighs against their stuff that they say about like, well, like it's long term, like we want to do this in the long term because this is the decision making and this is the actor that's actually in play here. The second thing they say is that, well, a crisis doesn't threaten all players, and this is said in MO, like you have surplus capital survive it, but this is not true if you engage in the traditional accounting and creative risky behaviors that Op wants. Because if it is the case, they want to spend all this money like getting the most aggressive analysts and appeal to aggressive investors, then you don't have the surplus capital to survive it because you use that capital on their side of the house. But secondly, like a lot of these banks, like even if it's not failure, a lot of these banks, as we explained in PMC, can still face significant harms. Like the fact you have to lay off much of your workforce, or you have to restructure or sell off some of your assets. Those are all things that are so harmful to you and your profits, even if it's not ultimate failure. That's not the only thing banks are worried about. They say fortress accounting fails under stress and you'll have erosion in the market. The opportunity cost is a lot worse. But here, the issue is that they fundamentally assume that other banks are all going to be performing better than you, but this is not necessarily true. We think it's likely that other banks are also going to make mistakes and fail in the same way with the analysis we've given you. That doesn't happen on their side of the house, that these banks are all significantly better. The risk that these other banks take will also punish them on their side of the house tremendously, especially when crisis happens. So yeah, maybe some banks survive or some banks outcompete you, but the vast majority of them are going to be in a worse situation than you when these crises happen. And this is also where we literally flip their stuff in MO about buying distressed assets. Like it's our argument. You have money to buy distressed assets on our side and you don't on theirs. If they say there's benefit of risk taking, let's take it when you don't have that much risk, when there's no one else to fight against you, and not when everyone is here. Finally, they say reputation in banking doesn't come from liquidity, it comes from seizing opportunities. But reputation in banking is about success and not losing people money. You can seize all the opportunities you want, but if you fail once, your reputation dies on their side. We know this reputation slower, but it still happens. Okay, second ballot then on why you don't reap the benefits of traditional accounting. I want to note, like, Op is stuck in a catch-22, and they don't respond probably to what Clement says about them needing to pick a side. Either it is the regulations are very strict and they're going to be careful, which means many of these banks are limited to be able to be innovative or creative as they say. And note, they drop the stuff on other actors who don't have those restrictions like PE firms or venture capital that we explained in PMC, which you're also competing against because these are also high return firms that your aggressive investors are looking into as well. It is on their side that the regulations aren't that strict and banks can engage in risky behavior. But there's a couple of reasons why they can't win in either situation. First, aggressive investors are going elsewhere, not to banks. They don't respond to this in PMC, and there's no the explanation of how PE firms are bubbling the status quo. There's so many more of these growing and much more competition on this front in comparison to the front of fortress like accounting. That's one you're definitely going to lose on their side. But second, middle ground is just parked on their side of the house. If they try to be like somewhat risky but somewhat not, then all the stuff about bigger banks or PE firms or more risky S&P 500 companies, which are higher return than banks, by the way, all still applies. So you're still losing on their side of the house. If it is true that they're going to win this on like profit, the issue is you're not getting that profit in either world. Either you're safe and you lose to those competitors, or you're risky but you're still unable to outcompete individuals who just have less regulations on them and more ability to be risky. So they're naturally going to beat you there. That means the weighing on profit just isn't enough. You're probably making enough. That's not the major concern to you right now, and you care more about safety and stability given the current crisis for these reasons proposed.